you, Taxmann, for having an advanced plan and purposefully keeping this particular session on 26th, mainly to ensure that all the critical questions which actually are going across on WhatsApp groups, etc., can be addressed in this particular session. So that's a very good vision which you had at the beginning of the month and purposefully keeping it on 26 so that we can address those questions. Now, as I'm saying today, the whole objective is to cover those questions which are running across in on the WhatsApp groups, and also to cover certain important elements which needs to be looked into while you are filing your tax audit reports, right? So that's the whole objective, with that objective I will just start the presentation. And these are the questions which have always been raised in the WhatsApp group in last 20 or maybe 15 odd days. Of course, the first one is, do I need to file the ITR for actual profit, or I need to show a lower profit of 8% or 50%? So yes, ideally, what the law says is that the deemed income is 8% or 50%, as the case may be. But what is important is that if you have a higher income, then you need to present higher income, or you need to report the higher income and not the lower income. So that's what the law is, and accordingly, if your income is higher than 8%, then you need to report more higher amount. That's the law. The second question which is going across is employees who are doing F&O business, whether they are required to get the audit done. Now, that's not necessary, because what the new law is saying is that if your business turnover is there below 10 crores, and if you have maintained your books of accounts, in that particular case you are out of section 44AD, because you are saying that you have maintained the books of accounts, and therefore while maintaining the books of accounts and you being below 10 crores, you are not liable for audit. That's what the law is, and therefore that particular ambiguity has been taken care of, which earlier was there. Question number 3, which goes around, is whether partnership firm with less than 1 crore having loss, whether they are required to do an audit. The same rationale which applies, which I spoke for point number 2, that in case if you are maintaining your books of accounts, the limit has got extended to 10 crores, and therefore you are not required to get an audit done because you are out of 44AD by maintaining the books of accounts. Now, this fourth question is very important, and I would just highlight this particular clause, because this is something which is brought out very by the guidelines note. What it says is that if you're a private limited company and if your turnover is less, that means you are already, being a private limited company, you are already into audit, which is a statutory audit, which is required under the company's law. So you're anyways getting an audit. Now, whether you are required to file the report under 44AB. Now, I'm just reading this provision because this provision is very vital. What it says is, provided also that in a case where such person is required by or under any law to get his accounts audited, it shall be sufficient compliance with the provisions of this section if such person gets the accounts of such business or profession audited under such law before the specified date and furnished by that date the report of audit as required under such law. This is something which is very clear, and we have been doing it since many years, that when we have an audit getting done into the other laws, then we used to file that audited balance sheet along with the returns. That we used to do. Now, guidelines note has given an emphasis on the words which are coming now, which says, the last line I'm reading, which says, and a further report of an accountant in a form prescribed under this section. So it says that along with your statutory audit report, which you are supposed to file, along with that, you are also supposed to file and in a form which is under form 44AB, which needs to be filed along with the report, even if your business is less. So that's something which the guidelines note had brought up, and that's what I wanted to highlight to our members who are listening to this presentation. So therefore, I have said that as also published recently in a common FAQ of ICI. So that's where even this particular point was highlighted, and therefore I wanted to bring it to our members' notice. Now I'm moving to the next question, question number 5, which is talking about that in case you are a trader. Okay, Now what happens is under 194R, as everybody is aware of, that the transactions which are not directly reported, which is basically the benefits which you receive in kind, right? Now, when the benefits are received in kind, earlier this were not getting reported anyway. But after the introduction of 194R, which specifically talks about the deductor who is giving this benefit, then they are supposed to deduct TDS under 194R, and that gets reported under our 26 years. So, let's say a case where a retail business or a distributor is basically getting a benefit from the manufacturing company in kind. Now, a manufacturing company is supposed to now deduct TDS under 194R, and uh, that particular benefit which you have received in kind now gets reported under your 26 years. So as an auditor, what is important to see is that whether that particular amount is already included in your profit, and if not included, then you have to specifically report it under clause 16. Now that's something which needs to be kept in mind, because this is going to be important from this year onwards, where an auditor is to ensure that whatever benefits which have been received in kind have got reported under profit and loss account, and if not reported, then as an auditor it is the duty to report it under clause 16, right? So that's what the question number 5 answers. Now these are, again, I am repeating that these questions have been repetitively asked on our WhatsApp group, on multiple WhatsApp group, and therefore I have brought those questions over here to answer it, so that it can be beneficial to our Taxmann members. Now I'm moving to the question number 6, whether IP address is required to be reported in clause 11. Now, this was something which generally have remained unnoticed. Why unnoticed is because as a part of our procedural factor and as a part of our conventional practice, what we used to do is we used to report this particular books of accounts maintained, address where the books of accounts have been maintained. All those things were always getting reported. But now the law is also asking us to report the IP address. Now, what is the provision? Let me read that, and that will give you the clear picture about what it says. In case where the books of account, I'm reading clause 23.10 of the guidelines note. What it says is, in case where the books of accounts are maintained and generated through a computer system, the auditor should obtain from the assessee the details of address of the place where the servers is located, or principal place of the business, or a head office, or a registered office, by whatever name called, and mention the same accordingly in 11B, where the books of accounts are stored on the cloud or online. So if you are having a dedicated server, then you have to report it where the servers have been located. If your data is managed through cloud server, then IP address, which is a unique address of the same, may be reported. The auditor should also specify which books of accounts have been maintained in a computer system and which of the records have been maintained in a hard copy. This we used to do it where things which have been maintained in hard copy and things which have been maintained in the computer systems, that was already getting reported. But what was not getting reported largely is the IP address of the server or a cloud server which we were using. That was not getting reported, with the guidelines notice saying that you should report that under clause 11. So that's something which is answering question number 6. Now I'm moving to the next question, which is question number 7. Now what it says, if the assessee is having turnover of less than 50 lakhs, okay, opting to audit due to loss under 44 ADA, whether TDS provisions are applicable. Now, because I'm into audit, the question is that because I'm into audit, whether the TDS provisions are applicable to me or not. That's the question, and that question has been answered by saying no. The reason is because TDS provisions have been independent provisions now, which says that if you are beyond a particular limit, okay, then you are supposed to get as a deductor, you are supposed to deduct the TDS. So it is now not linked with the requirement of whether you are under audit or you are not into audit. What is important is that whether you are exceeding the limit, the turnover limit which is specified, and if you exceed that particular limit, in that case you are supposed to get the TDS deducted. Now if you don't exceed that particular limit, in that particular case, though you are getting an audit done, you are not required to have the TDS provisions made applicable. So that's what the questions which have been generally moving across, I thought I will bring out to your notice. There have been many other questions, but those were some of the simple questions, or maybe the questions which you must be having an answers for. But these are the questions which I thought is important, and I have brought it to your notice. Of course, you can also raise further questions on Taxmann, and we can always answer if you have the questions in relating to filing of the audit on the last minute. If you have issues, we can of course answer those questions through the medium of Taxmann, which is doing a wonderful job. Now moving forward, let me now move on certain case studies which are also important while we are doing an audit. Now the first case study is talking about that in case if suppose there are, as a deductor, I have 4 deductees, out of which 3 deductees I have deducted the tax, and the 4th deductee I have not deducted the tax. The only reason of not deducting the tax is because though I have not deducted the deductee have paid the tax, and they have already given us a declaration by saying that this particular tax have been paid and it is certified by a chartered accountant, and now you are not supposed to deduct the tax. If that's the kind of a declaration which we are talking about, then I'm not supposed to deduct the tax, right? Now in that situation, how do I report it under 34A? Now this is something which is important, where what is the procedure? The procedure is saying that there is a specific dedicated procedure which is mentioned for doing this kind of a transaction, where the deductor is supposed to intimate to the deductee by way of a specific form which is available on the portal. After doing that, the deductee's chartered accountant will certify it, saying that yes, I agree to this, and I certify that yes, this particular income is already offered for tax. Once the deductee's chartered accountants give that certificate, it gets reported to through via traces. It gets reported to the assessing officer, and that also gets included as a part of our traces portal. So automatically that gets covered under the overall deduction formats. So that's how this compliance happens, and it automatically gets included into the part of 34A by considering it as that the person is already compliant with this particular provision. That's how we need to get it compliant. I'm not sure whether how many of the people have been aware about this, because this is something which is there as a part of the law from 2016, and it is a part of the portal since some time. And therefore, I wanted to bring specifically this to the notice of the members that and our fellow members, that the procedure has to be followed in order to be in compliant with 34A. Because otherwise, what used to be done is we used to get the declaration from the party, and we used to say that the declaration has been received and the deductor is not required. But what used to happen is that how do you report it? Because if you say that the total amount of tax, total amount of payment, then total amount of payment which is liable for tax, and total amount of payment on which tax is deducted. These are the 3 columns which I am sure everybody is aware of. Now, out of these 3 columns, which column will include this particular 4th deductee's details? That was always an important point which was not available clearly. But by following this procedure, you will be able to have the outcome of that getting reported under 34A, and that's something which needs to be noticed while you are doing this particular exercise. I'm sure, of course, there could be a lot of people who have not done this compliance. Now, in case if they have not done that, and now it is a short of time where you need to file the report, and therefore you don't have that much time available to do that particular exercise, what can be done is, of course, you need to do a reporting by saying it is in compliant, because the SSE is already in compliant as far as the law is concerned. So you have to say that the whatever is the amount on which tax is supposed to be deducted, that amount already have been deducted will be reported, and this is the amount on which now I'm not supposed to deduct the tax, because there is no need to deduct the tax. So you have to remove it from the some liable for taxation, and you need to bring it specifically as a part of your qualification or observation, where you can mention that this particular amount on which tax is not required to be deducted, and therefore it is not reflected under 34A as a specific liable for tax. It is reported as not liable for tax, and that's how you need to give that observation in your report. For this is something for the people who have not complied to the procedure which I have just referred to, and being a last minute solution, that's the one solution which you can adopt. So that takes care of this particular case study. And now I'm moving on to the next case study, which is important. I'm not sure how many people would be this would be important, but yes, this can play as a case study for even other kind of plannings which are happening. Now, if you are aware of what happens is, if it's a loss-making unit which is getting demerged with the profit-making unit, this is something which is a usual practice, where there is a loss-making unit of a business which gets demerged and that gets merged with the profit-making company. Now, the first question, of course, which arise is basically whether this how will be the procedure happen. So let me elaborate this case study. What happens is, let's say, suppose 2018 is the effective date from where the scheme is applicable, the demerger scheme is applicable, and it is approved in 2019. As an example, if you are able to see, it is saying October 19. So in October 19, let's say the scheme has got approved and it is effectively applicable from April 2018. Now, of course, you can understand that by 2019, I'm done with my filings. So I have already reported the loss. I have already reported my transactions as a part of demerged entity, and resultant entity has also reported their transactions. Now, what has happened is, let me take in a case where A has reported, B has also reported, and B basically a company which is has a different unit and all loss-making unit, and A is acquiring that particular business. So A has reported their transaction, B has reported their transaction in their independent returns. Now, what's supposed to be done is, because it is 2019, October 19, both have filed their independent accounts. Now, the demerger is effective from April 2018. So it's a retrospective effect. So all the losses of B has to get reported into A, right? All the transactions, income, profit and loss, etc., everything has to get reported into A as far as the demerger unit is concerned. Now that particular reporting has to be done. Now there is specific provision which has got introduced, wherein you need to file a modified return, which is ITR A, under which the resulting entity, which is the successor entity, which is A in our example, will have to do the reportings of that. There's a specific form which has a specific details to be filled in, and based on that, all this particular losses which was otherwise claimed in company B now will get disclosed in the by way of that modified return. It will get reported, and once that is reported, this new entity, the company A, will include all those transactions, loss, etc. Everything will get reported into A, and B entity will be reporting only the balance number of transactions, which is the unit which they are continuing. So that will be reported over here, and company A will be reporting their own transactions under the modified return, plus the transactions of the demerged entity which has got merged with company A. So that's how the procedure will get completed. That's about the procedure. We spoke about it. Now let's speak about whether the provisions of GAAR will be applicable in such kind of situation. Now that's very critical to answer. Before I answer that question, let me also go on to the credits, because TDA credits, now company, in the same example, company B has got reported under their 26 AS 20 TDS, right? Company A has not got that particular information in their 26 years. So 26 years still is not reporting that. 26 years of company B is reporting that. Now what to do? In that scenario, company B will have to file and intimate to the department that yes, these are the TDS which are there, which is although reflected in my accounts, but because of the order of the court, now this has to get merged with company A, and therefore the credit should be given to company A. Now that that is the procedure which will have to be done, and based on which the department will transfer the credit from company B to company A, and company A will be eligible to claim the credit of that. That's the procedure which has to be done in case of this kind of a unit activity. Yes. Now moving on to the next point. The next point is whether GAAR is going to be there as applicable, because loss-making entity and profit-making entity are getting merged, and therefore can the auditor or can the department, of course, will come later, but as an auditor, when you are reporting and you are certifying as a tax audit, whether you need to report these transactions or not under clause 30C, which is important. Now, what is important to see over here is you need to trail back to understand what is the importance of this demerger. Has the demerger only been looked into from the tax perspective, or it is also different reasons of doing it? Now, I will take you to this case study, what happened in this case study, because this is something I dealt with. And when I dealt with, I found out that what happened in this case is where company B was having losses, but they were having their network at particular region. Being a logistic companies nowadays, because the infrastructure is developing, this becomes more synergized, right? All the business are getting more synergized. So what happened is company B was there at a particular locations, and they were catering to a particular region, whereas company A was catering to many regions, but not those regions where company B was having their network base. And therefore there was a substance lying behind this particular demerger, wherein company B got merged with company A, so that it has company A as an holistic power in order to run this particular logistic business even in the region where company B was there. So because there was a commercial substance, number one. Number two is all the communications which happened between the company, all those communications were presenting very clearly that there is a commercial substance for doing this particular transaction. And because of that, this arrangement was made out of GAAR, because the whole primary objective is not only to have a tax saving, the most important objective was the commercial business. And by virtue of this was set out of the GAAR provisions. The second one again is important, because you must be coming across in the day-to-day activities in your regular audits. Also, you must have come across this situation, but maybe somebody may not have realized it. And since they must not have realized, I'm bringing it to the notice. So what happened is company let's say you have a company A which is basically owned by A and B. Let's say there's another company C and D, which is owned by wives of A and B. Okay, so there is one company which is A and B, whereas another company which is owned by C and D. So AB and CD are the companies. Now AB is companies which is having huge accumulated profits, and CD is the companies which is basically needing cash. Okay, now let's say company B is basically giving loan, whether the loan given by company A. So if the company AB is giving loan to company CD, whether that amounts to a deemed dividend or not, that is a question which we are talking about, because there's an accumulated profit in company AB. Now, and let's say if you are, by giving a loan, can tomorrow the tax auditor say that yes, because there is a loan given and there is a huge accumulated profit, there is a question of deemed dividend which is there, which needs to be looked into, and you have been covered by the GAAR provisions. Now, how do you judge this point? In this case, if there are two options where AB to pay off the accumulated profit by way of a buyback, which is liable for 20% tax, and dividend where you are liable for 30% tax. Because in case of a buyback, you are liable for 20%, and in case of a dividend, you are liable for 30% tax. In such situations, whether the GAAR provisions applies. So what is important to see is over here, when the law itself provides you the two opportunities or two ways of withdrawing the profit from the business, and if you are following one of the provisions, though that is allowing you to save certain amount of tax, that will not be covered under the GAAR provision. That's what it is trying to say from the case study. Now, since I have next 15 minutes to go, and I want to have 15 minutes for question answers for members to ask the questions, therefore, I will take another case study which is talking about this. This is important, and I want everybody to pay attention to this particular case, because I'm not sure how many people must have noticed this as imbibed in the law. What it says, if there is a repayment of loan by the company to its directors. Okay. So there's a company which has repayment of loan by the company to the directors payable on demand in cash. I mean to say, when I mean cash, it does not literally mean only cash. It can be journal entries, it can be transactions which are other than banking channels. Now, is this a violation of Section 269T? Now, the normal and the common answers will be that yes, this will be in the violation of it, because repayment of loan above a limit is not allowed, and that is covered, other than cash, of course, is not allowed under, and therefore it has to be covered under Section 269T. And therefore, let's read this particular clause. What the clause says in is about, of course, the loans and deposit, but they have defined under 269T only, not under 269 SS. We are talking about 269T, which is repayment. What it says is loans or deposit means any loan or deposit of money which is repayable after notice, or repayable after a period, and in case of a person other than a company, includes loans or deposit of any nature. So are you seeing the difference? The difference very clearly have been mentioned in the law, which says the loans and deposit means loans and deposits of money which is repayable after notice or repayable after a period. And in case of the person other than company, includes loans of deposit of any nature. So other than companies, loans and deposit of any nature is covered. But when it comes to companies, the loans and deposits which are repayable in a particular period and the repayable after notice, those are the only transactions which are covered. And therefore, if the loans and deposits are not covered under this clause for the companies, then they have been out of Section 269T. So that's something which is unusual, and therefore it is important to understand. Of course, what is important over here is the transactions which have already closed. Okay, you can take the cognizance, and you can take the this particular clause into picture. But while you are suggesting a client, while you are advising the client, I would not go on to advising it on this basis, because it becomes aggressive. But yeah, the law remains the same, that it talks about this particular definition as far as companies are concerned and other than companies are concerned, that there's a straight different definition as far as the loans and deposits are concerned for 269T. Moving on to the next one is reconciliation under GST under 44. This is something which, though have become very normal now. Clause 44, as we are aware about, is talking about GST reporting, where the expenditures are supposed to be reported, and the expenditures are supposed to be reported in terms of what are the exempt transactions, what are the transactions which expenditures which are with the registered dealers, and transactions which are unregistered dealers. So these are the three kind of reportings which is required to be done. And the purpose is ideally to identify that how many expenditures have been done with the registered dealers and how many of them have been done with the non-registered dealers. So that's the whole objective of this particular clause. And with that particular thing, what is required is whether breakup of total expenditure is required to be given or can be restricted to the revenue and capital expenditure. It can be restricted. Revenue and capital expenditure may be given. Headwise, nature-wise expense details are not required. So you can have it headwise, you can have nature-wise, but detailed is not required to be given. That's what the guidelines says. Whether the following expenses should be reported: depreciation, bad debts, etc. Expenses like salary, which are not supplied as a GST, ad hoc provisions of expenses like this, whether doctor, so this kind of expenses where it is not in relation to GST, whether that requires to be reported. In my personal view, it is not required, because these are the transactions which are specifically not in terms of supply of services or goods, and therefore they may not be get reported. But in case if you report it or you don't report it, if you make a proper observations in the notes, it is always better, so that the person who is going to analyze the audit report, or while the assessment is going out, you have already reported that this kinds of transactions are not reported, and not reported mainly because they are not into the supplies of GST. So they are, these transactions are not either a supply of service or supply of goods under GST, and therefore they are not required to be reported. That's the rationale behind that. Whether the doctors whose services are exempt are required to be reported, answer is yes, they have to report it, because the objective is the expenditure, whether when you have incurred it from with the registered dealers or non-registered dealer. That's the objective, and to achieve that objective, even if you are exempt, but still you are required to present your report. You have to report it under section 44. Now, when I go on to specific point, it is salary, whether reported or not reported, no. Remarks is no supply. As I said, depreciation, it's not an expenses. Bad debts, not an expenses. It's a provision for the doubtfulness. Provision for commission, auditor should add an observation that such amount is included in this column which pertains to this category. So if you are reporting it, then you have to add it accordingly. Loss due to theft like stock, cash, auditor should report this particular, add the observations whether the amount is not included, because not included in this particular column. So you have to do it report it accordingly, that such amount is not included in this column. So whatever call you take, either you report it, you don't report it, because of the rationales which you have, accordingly you can take a call and then report it in the observation that this is what you have followed. Expenses paid by the employees and reimbursed to them, and paid to the employees to the registered dealers. So if it is a reimbursement, then you have to get it reported, because you have made ultimately the payments have gone to the registered dealers, and therefore you should be reporting this transaction under the registered dealer. Now, since last 5 minutes have been left as far as the presentation is concerned, I'll just take this last case study, and this case study is in relation to the new provisions, where what happened is, let's say you had the transactions. Now the transactions were 115 BAA is the section which talks about a beneficial taxation rate, which is either 15%, 22%, whatever is the option which you are opting for under the new scheme. Now the question is that you are not allowed to carry forward the additional depreciation, and the additional depreciation which is a part of unabsorbed depreciation, right? So the law says that, let's say out of 100 rupees what you have, okay, 20 rupees belongs to additional depreciation. So 100 rupees is your brought forward unabsorbed depreciation. Now out of 100 rupees, let's say 20 rupees is additional depreciation. Now the law says, the crude law says that 20 rupees is not supposed to be carried forward, because that is something which is not allowed if you're opting for the new scheme. Now the question is that the 20 rupees which is not allowed to be carried forward. Now let's say 100 out of 100 rupees, if suppose you have already adjusted certain amount, let's say 30 rupees, okay, that you have already adjusted, okay. Now that 30 rupees when you have already adjusted, and 20 rupees out of 100, 20 rupees is something which was which is additional depreciation. Can you claim that 20 rupees is already got adjusted against the amount which I have set off, and what is left out is only 80, which is pure unabsorbed depreciation. It does not include any element of additional depreciation. Now, if you can claim that, because while you did the reporting in past, you have never presented different between unabsorbed depreciation, additional depreciation. That kind of presentation was never there in the past. The past was always having unabsorbed depreciation as a single column, which included additional depreciation, which included additional depreciation also. Now, my point to you is that now when you have opted for the scheme, at that point of time, can you say that the additional depreciation is no more carried forward? What is carried forward is pure unabsorbed depreciation, and therefore the whole amount should be allowed. That's the point which is there coming out from this case study, and I dealt with this particular case. So now my reading says that if you are able to, or I would put it in this way, that because you have claimed depreciation and you want to say That additional depreciation is what I have already set off. Now what is left out is only unabsorbed depreciation, and I want to carry it forward. Now while you do that particular thing, of course, with a word of caution, it is going to be an aggressive call, because that is not going to be absolutely free, because department is going to consider this as a point of debate, and that debate is going to be continued. But what the whole scheme of the depreciation is that whatever is the depreciation you have disclosed it, you have claimed certain. Now I am saying that that is additional depreciation which I have claimed, and what is left out is unabsorbed. Department might come and say that that is additional depreciation which is not set off. Normal depreciation has been set off. Balance is including additional depreciation, so you have to remove it. Now that is going to be an argumentative point, and that's going to be rest at the court. But yeah, this is something which recently I have come across this case, and I have therefore brought it out to the notice of members, that this is also one scenario which should be looked into while you are doing the finalization of audit, mainly for the people who are opting for the new scheme, and B, who have brought forward additional depreciation. So for those people, you should look from this perspective and then finally take a call. I'm sure I'm okay. There's one more case which I have to, which is allotted, and now I'll take this point also. That is basically capital rights. Now, what happened in this case study? This case study is trying to say that there is basically a out of court settlement. Okay, and because of the out of court settlement, there is some amount which I have received by way of a capital receipt. Now, reporting under clause 16E capital receipt, and not to be amount credited to profit and loss account. So because I have received the money as out of court settlement compensation, and that qualifies to be a capital receipt, I have not reported it to my profit and loss account, or not credited to my profit and loss account as not taxable, being a capital receipt. So give remark into form 3CA or 3CB, and not add it into capital receipt. Otherwise, what? So there's one column in the audit report. Audit report talks about amount of capital receipt which is not credited to profit and loss account. Now, what mistakes used to happen is when you report it into that particular column, it gets added to your computation, and automatically while processing your return, that amount gets added to the total income. And the remark which used to come up is that because it is a part of your audit report and auditors have qualified it to be considered as a part of income, you have been including it into the income. That's how it used to get accounted into your computation. Actually, what should be, if you get reported over there, then it gets added. So what can be done is that you consider it to be a capital receipt, and you can mention as a part of the note saying that though it is a capital receipt, but since it is not taxable, therefore, though it is not credited to profit and loss account, it is not reported under that clause. And we are separately disclosing that it is a capital receipt which is received by the company, which is not taxable. So that's how you can report it, and you can be compliant with it. Now, the last one is what kind of errors which are happening, because of which that there are chances of there being a scrutiny. Now, that can be that if suppose your due dates, so if the payments made before the due date under 43B or this, now, yes, the tax audit reports whether you, so let's say what happened in a case where you completed your audit, and you have disclosed that this transaction, this particular payment have not happened, and you have disclosed it by saying that it is not paid and therefore disallowed. Now, subsequently, the client paid the amount, and while they paid the amount, they claimed in the computation that it has been paid. Now, you need to revise it, right? So there's whether that option is available to revise. The answer is yes. You can revise your 3CD, your tax audit report. That option is available till the time your assessment year gets completed. So let's say we are talking about March 23, so March 24. Till that time, you can file the revised tax audit report. And there are three situations in which you can do it. One, when your financials have got changed. So if there is any change in it, that's one of the reason for doing it. Second reason is there are clerical errors which has happened while filing your tax audit, that you can look into that you can take into consideration. And the last one is when you are the example which I shared, that you have reported that the statutory payment have not happened and therefore disallowed under 43B or 40 AIA, but subsequently the client paid before filing the return because the due date for filing the return has got extended to October. So in that span, if he has paid, then you can of course file your revised report and say that yes, this is in compliant with your law, and therefore the credit the disallowance should not happen. And that's how you can revise your audit report, by asking that it should be allowed. uh, I, so that's about whether you can revise your audit report. In this three scenarios, you have an option and you are open to revise your audit report. I think I'm done with my presentation. I am having 15 minutes more to go, maybe 10 minutes, not 15 minutes. But yes, this is open for question answers and there can be questions which can be discussed. So I'll just check whether there are any questions which are there in the chat box. Yes, now can you give more information on third proviso to 44AB? This is in relation to audits, companies where the business is below the limit of 10 crores. Yes, so I will just go back to that particular slide to give you the answer for that. Just give me 1 second. The second question is, please rectify the audio. Every word is heard twice. I'm sorry. We are already on the last minute of the presentation. So if you have been not able to hear it, maybe you can just go through the recordings of it and have a revised hearing about it. The last one is Abhishek, case study 9. You have mentioned in 3 situations. Where is this provided those situations in SA or Rule 6 or clarification by the CBDT? Now that's something which I would just answer you. I would go to the first question and then come back to the third question. Yeah. The first question is, to go on a chronological order, the first question is related to the third proviso, which talks about, I would just read this provision. The provision says, and I would also like to read the guidelines note, which talks about this particular point. Just before I go on to the guidelines note, what the provision says. The provision says that provided also that in a case where such person is required by or under any law to get his accounts audited, it shall be sufficient compliance with the provisions of this section. If such person gets an account of such business or profession audited under such law means company's law, before the specified date and furnished by that date the report of audit as required under company law, right? So he has to furnish that particular report. And further it says, and a further report by an accountant in a form prescribed under this particular section. So it says that when you do the compliance of it, the compliance will happen when you are in the part, when you are complying with the furnishing of the report. Now this we always have the belief, we always have the pattern of not reporting this audit report. And as a practice also, we have not been reporting our tax audit report under 44AB, because we are always saying that my business, my turnover is less than 10 crores and therefore I'm not required to file the form 3CD. But what the provision is saying provided also that in a case where such person is required under any law to get its accounts audited, it shall be sufficient compliance with the provisions of this section if such person gets the accounts of such business or profession audited under such law before the specified date and furnished by that date report of audit as required under that provision, and further report the auditor further report an accountant report by an accountant in the form prescribed under this section. So it says you need to further report it. Now let me go to the guidelines note of it. I will just share it so that we read the guidelines note, what it says. Just give me a second. So now I'm just reading the guidelines note. What guidelines note says, guidelines note is saying, as per the third proviso of 44AB. Just give me 1 second. it says, as per the third proviso of section 44 AB of the Income Tax Act, in a case where such person is required by or under the law, if shall be specified compliance in the proviso. So that's the section which it talks about. And finally, it says that, just give me 1 minute. I'll just opening that particular guidelines note point. I'll just, by the time I pull out the guidelines note, I'll just answer the third question. The third question is talking about whether this is the three options which are available, whether that is available under the CBDT clarification or not. The answer is yes, it is specified by CBDT, wherein under three provisions, you are under three situations, you are allowed to revise your audit report. The only thing which they have said is that you need to complete and revise it by 31st of March 2024 as far as 23 accounts are concerned. That is by the end of the relevant assessment year. In that, till that particular time, you need to do it. That's the only condition, but otherwise, yes, CBDT has allowed you to revise your audit report in a span of 1 year, and that's before the filing of the if you are having three conditions, and in that situations you can. Now coming back to the question of third proviso, it says if a private company, now this is what I am reading about the guidelines note. It says if a private company has no turnover or its turnover falls below the threshold limit, is it required to undergo a tax audit compliance with the third proviso as stated above? Now that's what the question is there under FAQ. And the answer to that particular thing, I'll just say that it says that yes, it says that as per the third proviso, if a private company has no turnover or its turnover falls below the threshold, it is required to undergo a tax audit compliance with the third proviso of section 44AB as stated above. So as per the law, you are supposed to do it, is what the guidelines note says. But largely as a practice, what I have understood till now is there has not been any kind of such reporting which has been done. But yes, this is something as a practice we have not been doing, but what the guidelines note is saying is this is what I wanted to bring to your notice. Right, I hope I'm answering your question. Is there any more question? I'll just check if there are any more. Yes, so there is some more question. Yes, one private limited company making losses 2 years continuously, so nobody give the loan. Then the company received loan from relatives. Is it allowed? So company receiving loan from relatives, whether it is allowed, the answer is that first of all, what is important is that you are not in compliant with the company's law, because company is not allowing to have a loan from individuals. That's one of the important condition. But let's say if you say that nobody gives the loan and that the company receives loan from its relatives, is it allowed? As far as the income tax is concerned, that does not have an issue, but company law will of course have an issue. That's about your answer. Clause 44 is a column of total amount paid to the vendors including GST. If we pay any amount to the vendor against last year's invoice, needs to be added here? No, the answer is not required as such, because what is important, what you're reporting is the transactions which you've incurred in current year, and that needs to be reported, and that's what is getting evaluated. So if you have made a prior period expenditure and that you don't report it, anyways it is not getting allowed. So income tax would not have any issue as far as the substance is concerned, because you are anyway not getting allowed this transaction. However, if you go and do the revision of the previous year's returns, then yes, of course it is important to get it reported, because then of course you will not be able to report in that year, but you should at least report it in current year with an observation that this is what I'm reporting, and I'm revising my last year's return by claiming it as a prior period expenses in that year by revising it. But otherwise it is not required. can you highlight a bit amount of private limited company? This is what I recently did. I understand this is something which is critical, but as long as I am aware of, in practice, people have not been doing it. But yes, this guidelines not have therefore specifically raised this question, and they are saying that in the third proviso, you are supposed to do it. Under clause 44, parties which are not shown in GSTR 2B or books not recorded or claimed input tax on expenses can we show it in unregistered under GST. Under clause 44, parties which are not shown in 2B or books not recorded or claimed input tax on expenses can we show it in unregistered under GST. So you are trying to say that this which is not shown in 2B or books have not recorded it or claimed input tax for expenses, claimed as in expensive, can we show it as unregistered under GST? No, because the payments we have made it to the registered dealer. Since you have made it the payment to the registered dealer, you need to report it under the registered column. Yes, I think I'm done. So basically, thanks to Taxmann for getting this questions which have been asked into the various groups getting answered it over here. I would also ask the members or request the members if they want to be a part of a group which is mainly on question answer sessions where you can ask your queries, you can get your queries answered by the multiple members, multiple chartered accountants. There are a group of around 950 chartered accountants, and the link of that is available on the chat box, wherein you can join to that link. By joining to that link, you will be able to be a part of that WhatsApp group, which is of course a kind of a normal groups of chartered accountants where we all are there together. People raise their queries in their routine practices, and they are being getting answered for. So that's how you should be. You can take the benefit of that particular group. Waiting the link to download an FAQ of third proviso. Yes, so what I will be doing is you can get this particular link also on the ICAI portal, because that's the guidelines note is available over there. But sure, since you have said you have not found it, you can share your contact details if possible. I will ask specifically to share it with you, and or else you can just give me a WhatsApp hi, and I'm just mentioning my email ID so that you can just put it over there and I can answer it over there. I can forward it to you. So this is my email ID, and you can put a hello to me, and I'll just share the guidelines note over there with a specific paragraph mentioning over there, right? So this is all about the presentation, and this is all about the questions which have been recently going out. I would request members, if they want to be a part of that WhatsApp group where everybody are sharing questions and getting answers from those members, from 950 chartered accountants, they can always be a part of this group. And I'm done. Thank you very much.